Good evening, everyone. So now we're looking at our business management and finance, and our topic will be cash management. Cash management talks about the management of cash and how cash is being managed by an organization. Now, let's define cash. What is cash? We say cash is defined as the balance in a firm's demand deposits and currency on hand. So we are saying cash the is the balance, is a money, is a fund available at hand. That is cash. And your cash might not be at hand, might also be in the bank. That's what we say is a cash in the bank. Now the balances in demand deposits and cash on hand are unproductive assets of the firm, as these assets do not earn any interest. According to John Maynard Keynes, a firm has to maintain an adequate amount of cash for the following reasons. Now, what are the reasons why companies have to have cash? These are economic reasons why we hold cash, why we need cash. Now, one of the reasons why we hold cash, the reason why we need cash, the reason why there must be cash available is one, for speculative motive. For what? Speculative motives. Two, is for precautionary motive. Then for three is for transaction motive. For speculation motive, is the need to hold cash to take advantage of additional investment opportunities such as bargain purchases that might arise, attractive interest rates, and a favorable exchange rate fluctuation. So why do we need cash? We need cash for any speculative motives. Maybe when we find out that there is a a a a, a transaction or an arbitrary transaction whereby we can make profits, we can make interest spontaneously without waiting for the end of the year or for the end of the month. That means when you find out that there is a fluctuation in a currency exchange rate, maybe the rate they sell cash or sell for foreign exchange, like example dollar in Benin, for example, is lower than the price of a dollar in Lagos. So for that reason, we can make profit when we can buy dollar in Benin and sell dollar in Lagos. That difference is the profit we make. Now, for precautionary motives, is the need to hold cash at a safety margin to act as a financial reserve. So we hold cash for precautionary motive, or okay, maybe for unforeseen circumstances. Then number three is for transactional motive. Is the need to hold cash to satisfy normal distribution, disbursement and collection activities with a firm ongoing operations. So we need cash for our normal day-to-day running of the organization. So you want to pay for some expenses, you need cash. That is why a company, an entity must have cash. Now, the objective of good cash management. Now, objective of good cash management. The objective of a good cash management is to hold sufficient cash to meet liabilities as the first due, while making sure that not too much cash is held. Money held as cash is not being invested in the wealth creating asset of the organization, thereby affecting profitability. Now you have to understand cash. Cash has so many implications on on an organization. We're saying that a company that holds so much cash, that why do you have to hold enough cash, excessive cash? You said cash does not have any value to an entity. Rather, cash will affect your profitability, because when you hold enough cash, for example, holding a cash in a bank, we warrant you to incur um some expenses, because many organizations opens a current account, and a current account doesn't have an interest. And moreover, current accounts we always have, they will always charge you maybe for maintenance costs and for other costs. So saying that cost will be reduced about your profit. So cash does not have any does not have value to an organization. If a business entity wants to maintain sufficient liquidity but does not want to hold too much cash, it might consider investing cash that is surplus to short-term requirements. When you have enough cash, surplus cash, you have to invest those cash in a short-term investment, such as the savings account, by purchasing of a treasury bills, for CDs, that is a CDs, that is for commercial deposits. The aspect of cash management, you might be required to consider any of the following three aspects of cash management. For cash management, we have three major aspects of cash management. One, forecasting cash. One, forecasting cash flows, requirements, and operational cash flows. This is done by means of cash budgeting or cash flow forecasting. That means cash management talk about forecasting cash, or this cash cash forecast or cash budgeting. So you need to understand the meaning of cash budgeting or cash forecasting. Two, deciding how to invest surplus cash in short-term investment. So you need to know how to invest short-term cash in short-term investment. Okay, deciding how much cash to keep and how much to invest in short-term investment. You need to know how much cash you need to keep and how much you need to invest in short-term investment. The cash management function in a business firm is concerned with the following areas. The following areas. Now, cash collection procedures. To manage cash, we need to understand how to collect cash, because when you company sells on credit to its customers, now how do they manage cash? How do they collect the debtors? So that is what we call by the cash collection procedure. The importance of cash collection process for business firm varies in direct proportion to its size. Small local firms may be able to survive with simple cash collection procedures, but large, which is a national firms, must be able to design an efficient system to collect cash from all their customers and make timely payments to their suppliers while maintaining adequate liquidity at all times. Now, what was the cash collection procedures? We're saying what are those procedures put in place by an organization to retrieve, to collect cash from their what, from their debtors, from their customers, and how would they negotiate an a an favorable payment procedure to their suppliers. Now, the speed the speed up collections and to reduce the float, firms use a varieties of techniques, some of which are listed below. What are those techniques used in collecting cash? One, decentralizing collection system. Two, pre-authorized checks, pre-authorized check, special handling, payments by wire transfer, determination of optimal cash balance. So we need to determine the optimal cash balance an organization must need. You want to know what are the optimal cash balance an organization must need. Yeah, we need to know um when you look at Determination on optimal cash balance. You must have heard about what we call EOQ, economic order quantity. It's talking about what is the order quantity and on inventory we need to hold. What are the quantity of inventory we need to hold to run our business? It's the same thing talks about cash. We need to know what the the minimum the minimum requirement or the minimum cash an organization needs to hold in a specific in a particular period of what time. Cash disbursement techniques. Cash disbursement techniques. Cash disbursement techniques. Why cash collection techniques are designed to speed up the collection of cash by reducing float. The cash disbursement procedures are structured so that the firm can delay payment as far as possible without incurring the displeasure of its what suppliers. Now, cash disbursement techniques. We're talking about what are those techniques an organization must to put in place in order to ensure that they pay their suppliers. They delay the payment to what to suppliers, because when you negotiate a longer period of credit from your supplier, that is more preferable. It's better for the what organization, because the organization will have enough cash to run its business before it pays its suppliers. Now, now let's talk about the cash budget and cash flow forecast. Now, I would say cash budget or cash flows forecast. Now, a cash budget or cash flows. Normally, this is a topic that will be treated under your financial accounting. Um, accounting, there will be a standard under your financial accounting that will talks about that will talk about that will talk about cash flows, and is IES 7, which is cash flow statement. Now, this standard, you able to understand what is cash flows and what is the importance of cash flow statement to and what organization. And what is cash budget? Now, say cash budget. Say a cash budget. A cash budget is a detailed plan. It's a detailed plan of cash receipt and cash payment during a planning period. Now, a cash budget will show a details of all your cash receipts. You talk about all the cash that will be received in a particular period and all the cash that will be paid in a particular period. The planning period is subdivided into shorter period, and the cash receipt and payment are forecast planned for each of the subdivisions of time. The main use of a cash budget are as follows. Now, what is the importance of cash budget? Why do we need a cash budget? Why do we need a cash budget? Now, one of the uses of cash budget is one, to forecast how much cash receipt and payment are expected to be made over the planning period. Now, two, to learn whether there will be a shortage of cash at any time during the period or possibly a cash surplus. So, a cash budget will help an organization or will help an individual to know if there will be a shortage of cash in the future, or there will be surplus of cash in the future. So, preparing a cash budget, we allow the companies to know where if there will be shortage of cash or there will be surplus of cash in the future. 3, if there is a forecast shortage of cash, to consider measures in advance for dealing with the problem. Now, the cash budget will also allows you, okay, when there is a shortage of cash in the future, what are those plans you have to put in place to treat or to reduce or to comb the shortage of cash in the future. Now, for example, by planning a defer some purchase of non-current assets or approaching a bank for a larger bank overdraft facility. Now, when you forecast there will be shortage of cash in the future. That will help us to know how to manage the shortage of cash in the future. Number four, to monitor actual cash flows during the planning period by comparing actual cash flows with the budget. Now, we are able to monitor the actual cash flows and the budgeted cash flows. Now, preparing a cash budget. How can we prepare a cash budget? As I said before, I said IAS 7 cash flow statement will help you to prepare a cash statement. But here we're talking about the cash budget, not cash flow statement, the cash budget. We said a cash budget can be prepared by producing a table for the cash receipt and cash payment, containing each item of each receipt and each item of cash payment. Now, to prepare a cash budget, you must know a table whereby it shows all the cash receipts and all the cash payments. The cash receipt and then the cash payment should be listed in rows of the table, and each column of the table represents a time period such as 1 month. Now, cash flow forecast. How can we do a cash flow forecast? So cash flow forecast, like cash budget, are used to predict future cash to predict a future cash requirement or future cash surplus. However, unlike a cash budget, they are prepared throughout the financial year and are not a part of a formal budget plan. Now, if a cash flow forecast will be prepared throughout the financial year, that means it will be for a year, they are often prepared in much less details than a cash budget. A cash flow forecast, they are lesser details than a cash budget. The main objective of cash flow forecast, like the cash budget, are as follows. Now, why do we need to prepare a cash flow forecast? One, they have similar characteristics, but one of the main objectives of cash flow forecast is, one, it makes sure that the entities is still expected to have sufficient cash to meet its payments complement as they fall due. Two, identify period when there will be a shortfall in cash resources so that financing can be arranged. Identify whether there will be a surplus of cash so that the surplus can be invested. Assess whether operating activities are generating the cash that is expected from them. The main focus of cash flow forecasting is likely to be operating cash flows, although some investing and financing cash flows might also be significant. Now, the difference between a cash forecast and a cash budget is that the cash budget a cash budget will only segregate the forecast into receipt and payment without differentiating the operating activities of the entity and the financing activity of the entity and the investing activity of the entity. That is the difference between a cash forecast and a cash budget. Now, the techniques for preparing a cash flow forecast. So there are no rules about how to prepare a cash flow forecast. A forecast need not be in the same amount of details as a cash budget. However, there are two basic approach that might be used. Now, the two approach is, one, producing a cash flow forecast similar to a statement of cash flows, preparing using the indirect method. Now, when I say a cash flow forecast will be prepared using the approach of the IS7, the cash flow statement. The cash flow statement. You can use the indirect method or the direct method or the direct method. Two, forecasting the cash flows by estimating revenues and costs to arrive at an estimate of earnings before interest, tax, and depreciation. That is called okay. Now the cash flow statement approach. We said we can use two major approach. It's either you are using the cash flow statement approach or you are using the forecasting your cash flow from your revenues and costs. Now, using the cash flow statement approach is one way of preparing the cash flow statement approach is for a period of time is to produce a statement similar to a statement of cash flow in financial reporting. The general structure of the forecast will therefore be as follows. One, doing that you will use the one similar to what the financial reporting, which is your financial accounting in a foundation level. Now here we'll talk about the profit. Now we'll work from the profit. Now when you work on the profit, you will adjustments for non-cash item. What are those items that are not warrant cash? That are like provisions. So one of them is depreciation. One of them is what? Depreciation. The next is adjustment for working capital. What's working capital? We're talking about your current asset and your current liability. Now you add decrease in current assets. Now what does decrease in current assets? You add it. You will less increase in current assets. You add increase in current liability. Then you less decrease in current liability. Then you have your operational cash flows. Now when you do this, the solution of everything will give us operational cash flows. Then after operational cash flow, you have to pay your interest. So your finance charge in your profit or loss account, you will not pay the interest. Then the next thing is to payment of tax. You pay your tax. Then after that, you get your cash flow from what? Operating activity. Now you go to investing activity. What are those things under investing activity? We talk about the sales of non-current assets. So the sales of non-current assets, you add it. You less purchase of non-current assets. Get your cash flow from investing activity. You go to financing activity. Less repayment of loans. Less payment of dividend. When repayment of dividend, you less it. You add dividend receipt. You receive a dividend. Maybe the company invests in another company. You see dividend. You will add that. You will add new issue of shares. So when the company issue new shares during the year, you will add that. The cash flow from financing activity, which is C. By the time you add the A, which is operating activity, the B, which is investing activity, and C, financial activity together, we will have the net change in cash position. Then you add the cash flows at the beginning of the year. Then you get your cash flow at the end of the year. Maybe we'll look at a question later under the cash flow statement. Now the other method is revenue and cost estimation approach. Here you are working from your profit, from your sales. Here you have your sales. You less your cost of sales. Then it will give us our gross profit. Then you less other expenses. You have your net profit. Then you add depreciation and amortization. Then we have your profit before interest, tax, and depreciation and amortization. So the figure for EBIT, EBITDA, is equivalent to the figure in the cash flow statement for operational cash flows before working capital adjustments. Adjustments can be made to EBITDA, that EBITDA for working capital changes, interest and tax payment, investing cash flows and financing cash flows in order to arrive at est- an estimate of the net cash flow surplus or deficit for the period. Depreciation and amortization. Now, what you need to know understand that, let's look at free cash flows. What the meaning of free cash flows? The free cash flows. The concept of free cash flows might also be used in cash flow forecast. Free cash flows is the amount of surplus cash flow after allowing for all cash payments that are essential and non-discretionary. Free cash flow is the amount of cash flow that management is able to use as their discretion for any purpose. Now, also free cash flow is the cash flow that the company or the firm will have. Now, the free cash flow is what the company will have after every expenses. So the free cash flow is now used by the management in their own discretion, either to save it, either to plow it back to the company, or to distribute it as what, dividend. So now it's left for the management to decide on what to do with free cash flows. Now this is a format for also for free cash flow, so we can look at the format for free cash flow. Now let's talk about other aspects of cash management. What are the other aspects of cash management? Uses of surplus cash, that is investing short term. Now, when we have a surplus cash, how do we use surplus cash? So surplus cash should be invested. It should be invested in short term investments, because when you invest your surplus cash, it will generate additional inflows to the company, because holding surplus cash does not add any value to the organization. Surplus cash arises when a business entity has cash that does not need immediately for its day-to-day operation. Surplus may be may, may be may be surplus may be short term, that is temporary. When a surplus is identified, the entity should plan how to use it. Holding it as cash is wasteful, because cash in a business bank account ain't no interest. That is what I'll be explaining. Because when you say that was a surplus cash, we don't have to hold an excessive cash, a surplus cash in the bank account of an organization, because it does not earn additional interest. So why don't we invest it in a short term investment? So we need to understand what are those short term investments in which we can invest our short surplus cash. When deciding on how to use temporary surplus cash, the following considerations are important. Now, when you want to invest in the surplus cash, you must understand some terms, things that will guide you when you want to invest in a short term investment. One, liquidity. Short term investments should ideally be liquid. This means that they should be convertible into cash fairly quickly as a fair price and without difficulty. We are saying you should be able to convert them into cash quickly. Into cash what? Quickly. So for example, when you purchase a treasury bill, you can sell them at any period of time. The more liquid the investment, the easier it is to convert it back into cash. Okay, the next thing you have to consider is safety. Safety, because the level of investment risk should be acceptable. There is a risk of losing money on the investment due to a fall in its market value. With investments such as a savings account, there would be no risk of capital loss, but the interest on the savings might be very low. Now, when I talk about safety, that means you have to invest in a particular instrument where safety is now after safety you have to consider profitability. That means for you investing in a short term investment, there are um three major things you have to consider. Consider the liquidity of the investment you want to invest on. Consider the safety on investment, because on investment, when you invest on them, that it might not, the risk involved might be high. So you might lose the interest and also lose the principal value. Now, profitability, the aim should be to earn the highest possible return on the surplus cash, consistent with the objective of liquidity and safety. So when you invest in any particular short-term investment, there are a range of short-term investments. So look at the one that have more profit, the one that is that yield more profit. So you can invest on such an investment. Now, the cash management in a large organizations is often handled by a specialized department. Now, the cash management in some large organization, cash management it has its own arm from the finance and accounting department. Now, these people, they handle the cash, they call them on the treasury department. Now, one role of the treasury department is to centralize the control of cash, to make sure that one, cash is used as efficiently as possible. Surpluses in one part of the business are used to fund shortfalls elsewhere in the business. Surplus are suitable, invested, and um and mature when the cash itself is needed. Now, the advantages of this centralized department is one, the cash is advantages of you of company having a treasury department or using a specialized department to handle the cash is that one, the cash is managed by a specialized staff involving in cash management efficiency. Now, because it's not managed by accounting staffs, it's managed by specialized staff, those that are knowledgeable in cash management. So, and two, all the cash surpluses and deficits from different bank accounts used by the entity can be pulled together into a central bank account. Now, that means you can also pull them. This means that the cash can be channeled to where it is needed, and overdraft interest charges can be what, minimized. Three, central control over cash lowers the total amount of cash that needs to be kept for precautionary reasons. Then putting all the cash putting all the cash resources into one place increases the negotiating power of the treasury department, or or to or, or to get the best deals from the banks. Now, the function of a treasury department. So in our exam, we must ask, okay, state the function of a treasury department. The centralized treasury department is responsible for making sure that cash is available in the right amount at the right time and in the right place. To do this, it must one, produce regular cash flow forecasts for predict surplus and shortage. So the treasury department regularly, they are in charge to predict the cash flow forecast. To arrange the short-term borrowing and investment when necessary. So they help to arrange the short term, those overdrafts from the bank. They help to arrange those investments, arrange to purchase foreign currency when needed. So they help to arrange when the company needs to purchase foreign currency. They help you to arrange the foreign currency. 4. Purchase the business risk. Protect the business against the risk of adverse movement in the foreign exchange rate when the business has receipts and payments or loans and what investment. So they help the organizations to manage the adverse movement in the foreign exchange. 5. Deal with the entities bank. They have to deal with the entity bank. So when you want to meet the banks for anything, the treasury department, they helps to deal with the entity bank. Finance the business on a day-to-day basis. For example, for arranging facility with the bank. So it helps to finance the business on a day-to-day basis. So when they need to collect an overdraft, to arrange for overdraft, they helps to do so. Advised the senior management on long-term financing requirement because they are knowledgeable in financial management. So they have to advise the senior management in terms of financing decision. So with this, we've come to the end of today's topics. Maybe in our next class, or we'll look for a particular time. I'm going to pick out the questions that will address this topic. So see you in our next class. Good night.